All right, let's dive right in. Welcome to today's explainer. We are going on a really fascinating journey today, zooming all the way out to the macro mechanics of how money is literally born, and then zooming all the way back in to the micro-level strategies of the world's most elite investors. We're going to connect some dots in the financial world that, at first glance, might seem completely unrelated.
Because honestly, what do the hidden back-end mechanics of money creation have in common with elite hedge fund strategies? I know, it sounds totally wild, right? On one hand, you've got the philosophical foundation of what a dollar even is. On the other, you've got these highly aggressive, super secretive hedge fund trading floors. But, as we're about to see, understanding the foundational flaws and the structural imperfections of our financial system, well, it perfectly explains exactly why these alternative investments don't just exist, but why they absolutely thrive.
So, here's our game plan for today's explainer. First, we'll unpack the true nature of money. Then, we'll rethink modern finance theory, explore the hedge fund advantage, categorize their main strategies, put a massive spotlight on managed futures, and, finally, break down the life cycle of a trend.
Okay, starting with part 1, the true nature of money and why we really need to break that textbook illusion.
We literally have to start with the most fundamental, mind-bending question possible. Where does money actually come from? Because the reality is way different from the neat little textbook illusion most of us were taught in school. You see, there's a really stark contrast between what we call active money and passive money. Historically, active money just emerges spontaneously, no state required. Think of gold, silver, or even those massive stone coins they used on the island of Yap. It functions as an asset, a commodity used for exchange based purely on social convention and trust. Passive money, on the flip side, that is essentially just a measure of debt. It's a liability. In our modern system, the money sitting in your checking account right now is passive money. It is private debt created by banks operating with a government license. And that brings us to something that kind of turns everything upside down, the counterintuitive reality of fractional reserve banking. Textbooks love to tell you that banks take in deposits from savers, lock a tiny fraction in a vault, and lend out the rest. But actually, scratch that. It's entirely backwards. In the real world, banks do not lend out existing deposits. They actually create the deposits out of thin air by extending credit first. When a bank approves you for a loan, they just digitally credit your account. Boom, new money. Only after creating that new money do they turn around and ask the central bank for the required minimum reserves, which was often just 1%. It's this massive, continuous engine of money creation. Which brings us to part 2, rethinking modern finance theory and the theoretical friction this whole system creates. So, realizing that credit creates money and that our whole system is fundamentally driven by human action and debt brings us to a major crossroads in how we understand market behavior. We have to look at 2 competing lenses here. First, modern finance theory. This is the engineering science that gave us the capital asset pricing model. It relies on this idea that markets are perfectly efficient. It assumes investors are basically rational robots, that risk can be perfectly measured with math, and prices fall neatly into a predictable bell curve. But then, you have the Austrian School of Economics, and they look at the real world and argue, wait a minute, human action operates in a world of unmeasurable, radical uncertainty. The Austrian view says people rely on subjective knowledge. We make mistakes. Markets are in a continuous, messy state of disequilibrium. Think about it. If markets were perfectly rational, there'd be no mispriced assets. But because humans are emotional and biased, inefficiencies are literally everywhere. That leads us right into part 3, the hedge fund advantage, or how to actually capitalize on all that uncertainty. If markets are driven by human behavioral biases rather than perfect robotic efficiency, how do the pros make their money? Well, hedge funds are built from the ground up for this beautifully imperfect world. They operate with incredibly flexible mandates. They aren't forced to just buy and hold stocks like your average mutual fund. They use daring approaches, shorting assets they think are going to tank and using moderate leverage to juice their returns. Now, to pull this off, they have to impose liquidity restrictions on their investors, things like initial lockup periods. This lets the fund managers ride out crazy market volatility without being forced to sell off assets during a panic. And for providing this specialized expertise, they charge elevated fees, typically a 1% management fee plus a 10 to 20% incentive fee on the profits. They are structured to exploit the exact market imperfections we were just talking about. So, what does this look like in practice? Let's hit part 4, categorizing hedge fund strategies and checking out their diverse toolkit. When you look at how these funds generate those massive returns, they use a vast array of specialized strategies. You've got your equity-related folks going long on strong companies and shorting the weak ones. You have event-driven strategies hunting for corporate drama, mergers, acquisitions, bankruptcies. Then there's relative value, which is all about finding tiny pricing gaps between two very similar securities. And finally, you have opportunistic strategies, which take a top-down view of global macroeconomic trends. Every single category is a precision tool designed to extract money from specific market inefficiencies.
And that leads us perfectly to part 5. We're putting a spotlight on managed futures and how they thrive in extremes.
Out of that entire hedge fund toolkit, we are going to zoom in on one of the most fascinating opportunistic strategies out there, managed futures. These funds essentially operate on pure momentum. The theory is wonderfully simple, even if the execution is super complex. Systematically buy what is going up and short what is going down. That's it. They apply this trend-following strategy across dozens of liquid exchange-traded contracts, commodities, equity indices, currencies, government bonds. If natural gas is trending up, they buy it. If the Japanese yen is trending down, they short it. They aren't sitting there trying to guess the underlying fundamental value. They are just riding the momentum of human behavior.
And the data on this is wild. It forms what the industry calls a smile. It perfectly illustrates this counterintuitive reality. Managed futures perform their absolute best when traditional markets are either aggressively crashing or massively booming. Why? Because extreme bear or bull markets rarely happen overnight, right? They're the result of a long continued trend. Back in the catastrophic fourth quarter of 2008, when literally everything else was burning to the ground, managed futures were positioned short on equities and long on government bonds, and they profited immensely as that downward trend just kept going.
Plus, here's the kicker. The average correlation between these single asset trend strategies is a minuscule 0.08. They act almost completely independently of one another. Gold trending up has basically nothing to do with Australian bonds trending down. So this ridiculously low correlation provides massive diversification benefits. It protects the portfolio even when the broader financial system goes into total shock. Which brings us to our final section, Part 6, the life cycle of a trend and the anatomy of market behavior. So, why do these trends even exist in the first place? If markets were perfectly efficient like modern finance theory claims, prices would instantly adjust to new info. There'd be no momentum to ride. Well, you can treat a financial trend almost like a living organism. It's born from a sudden catalyst, like an unexpected earnings report or an oil shock, but the market doesn't instantly price this in. Human bias causes an initial underreaction. People are slow to adjust. As the price slowly starts drifting, a managed futures algorithm starts buying in. Then the trend explodes through herding. Other traders see the price moving, they pile in, confirmation bias kicks in, and the market totally overreacts. Eventually, the price extends way beyond its actual fundamental value, the trend dies, and the price reverses. There's a brilliant quote from Nobel Prize-winning behavioral economists Tversky and Kahneman that hits the nail on the head here. They said people anchor their views to historical data and adjust their views insufficiently to new information. That is the exact psychological friction that creates these trends. We hate selling our losing stocks because we don't want to admit defeat, and we sell our winning stocks way too early just to lock in that quick gain. It's our own highly predictable human flaws that create the exact momentum that managed futures ride to profitability.
So, pulling this all together, we've gone from the raw creation of money out of thin air to the radical uncertainty of human action, right down to how elite investors weaponize our everyday behavioral biases. I've got a final provocative thought to leave you with today. The next time you hesitate to sell a losing investment or you feel that sudden urge to jump on a bandwagon just because everyone else is, ask yourself, how are your own everyday financial reactions secretly fueling the massive profits of these elite hedge funds? Thanks so much for joining me on this explainer, and I'll catch you next time.